Remarkably, we are going to resume, and we're only 15 minutes off schedule, which gives us an opportunity to have a very full discussion. We've talked about monetary policy this morning. We've talked about central bank policy. We've had controversial papers, a summary and history lesson from Bill Miller, and now we have a marvelous panel. Let me just describe for 1 minute what we are going to attempt to do. If there's anyone in this room who doesn't know the three personalities plus Julian Callow from Barclays, on this panel, lunch will be served to you at McDonald's next door. Let me say this. We have a wealth of experience ranging in a period of time in which history books are being rewritten. All three speakers have been in the midst of the firing line, as has the moderator. We should hear what they have to say. We're trying to construct the following format. The format will be that each of our three speakers will have some comments to open. They've agreed then to have a moderated chat conversation with Julian Callow. And subsequently, if we do it in a timely way, there'll be some dialogue, short questions, please, not alternative speeches from the audience. And we ask that the media, members of the press, please do not ask questions. We want this for the participants in the conference. So without further ado, Julian, will you start the panel?
Thanks very much, David. So in that spirit, let me first call upon Charles Plosser for the first intervention. Thank you.
I'm going to move this so that I don't knock it off after that. I used to be very technologically advanced, but as I become a central banker, you regress technologically. So anyway, I'm delighted to be here today in this beautiful city, in this gorgeous room, and to have the honor to serve on such a distinguished panel with both friends and colleagues. David Kotok, as you know, has been the guiding force behind the GIC conferences over the past several years. He and his team at the GIC have never failed to gather an interesting and knowledgeable group of people to discuss important issues on truly global issues. So I want to thank him and the GIC for their efforts and contributions, but I also want to thank our host, Christian Noyer and the Banque de France, for their hospitality and wonderful setting here in Paris. So I'm going to take a little different tack on the subject matter of this gathering, and rather than focus on what new orthodoxy we should take away from the financial crisis, I'm actually going to argue we need to restore some of the old orthodoxy. David did suggest he wanted to have some time for conversation on important issues. So, like Paul, I'm going to be somewhat provocative, perhaps in a different dimension than Paul was. As usual, I have to stress that these comments are my own and not those of the Federal Reserve System or my colleagues on the FOMC, as they take great relief in knowing. So I'm going to focus my remarks on two topics that have emerged as a consequence of the crisis. First is the relationship between monetary policy and fiscal policy. And of course, we had a provocative and fascinating conversation this morning with Paul McCulley on this very topic. The second topic involves the role of central bank balance sheets as a policy tool. These are two issues that I believe are of fundamental importance, not only for all our societies, but for central banks in particular as we move forward over the coming years. So let me begin by sharing some thoughts on the appropriate relationship between monetary policy and fiscal policies. So in the wake of the international crisis, financial crisis, and the ensuing recession, many countries around the world responded with significant increases in government spending. Some of this increases came about of the usual what economists call automatic stabilizers. But there's also been a dramatic expansion in budget deficits attributable to deliberate efforts to apply fiscal stimulus to improve economic outcomes. This expansion of government spending has been very significant in the United States, but it's also occurred in other countries as well. So what does this have to do with monetary policy? Well, I think in fact it has a great deal to do with monetary policy. It is widely understood that governments can finance expenditures through taxation, debt, of course debt is just future taxation, or printing money. In this sense, as Paul talked about this morning, monetary policy and fiscal policies are intertwined simply through the government budget constraint. But for good reason, societies seem to have converged towards an arrangements that provide a fair degree of separation between the functions of the central banks and those of their fiscal authorities. For example, in a world of fiat currency, central banks are generally assigned the responsibility for establishing and maintaining the value of the purchasing power of the nation's unit of account. Yet that task can be undermined or completely subverted if fiscal authorities set their budgets in a manner that ultimately requires the central bank to finance government expenditures with significant amounts of seigniorage in lieu of current or future taxes. This, of course, is just the flip side of what the example Paul McCulley gave you this morning, where he worried about monetary policy. He described a world in which monetary policy dominates. I just described a world in which fiscal policy dominates. The Sergeant Wallace proposal, or the Sergeant Wallace paper that Paul mentioned this morning, it's important to note, though, is not about the budget constraint at a point in time. It's about the present value of the budget constraint and the present value of spending and the present value of debts and how they emerge in a dynamic process, not just a point in time. The ability of central banks to maintain price stability can be undermined not only by fiscal authorities, but can be undermined when the central bank itself ventures into the realm of fiscal policy. History teaches that unless governments are constrained either institutionally or constitutionally, they often resort to the printing press to escape whatever appear to be intractable budget problems. And the budget problems we face in many countries today are indeed challenging. But history also teaches that resorting to the printing press, those little Federal Reserve notes in our case, in lieu of making tough fiscal choices, is a recipe for substantial inflation, and in some cases, hyperinflation. Awareness of that long-term consequence of using the printing press instead of making tough fiscal choices is the reason that over the last 60 years, country after country after country has moved to establish and maintain independent central banks. That is, central banks that have the ability to make monetary policy decisions free of short-term political pressures. Without the protection afforded by independence, the temptation of governments to exploit the printing press to avoid fiscal discipline is often just too great. Thus, it is simply good governance and wise economic policy, from my point of view, to maintain a healthy separation between those responsible for tax and spending policy and those responsible for money creation. But it's equally important for central banks that have been granted independence to be constrained from using their own authorities to engage in activities that are more appropriately belong to the fiscal authorities or even the private sector. In other words, with independence comes responsibility and accountability. Central banks that breach the bare boundaries risk their legitimacy, their credibility, and ultimately their independence. So given the benefits of central bank independence, losing that credibility and independence could prove costly to society in the longer run. Now, there are a number of approaches that societies have used to placing limits on independent central banks so that the boundaries between monetary policy and fiscal policy remain clear. First, central banks can be given a narrow mandate, such as price stability. In fact, this has been the prominent trend during the last 25 years. Many central banks now have price stability as either their sole or at least their primary mandate. Second, central banks can be restricted as to the type of assets they hold on their balance sheets. This limits its ability to engage in credit policies and resource allocations that rightfully belong to the fiscal authorities, or the private marketplace for that matter. And third, central banks can conduct monetary policy in a systematic or rule-like manner. Indeed, this very argument was used by Milton Friedman, that devil of a monetarist that Paul would call, for his K% rule for monetary policy. It was a way of limiting the discretion or limiting the ability of a central bank to use its considerable authorities to engage in mischievous, in his view, activities. Taylor rules are another example of systematic policies. Unfortunately, over the past few years, the combination of a financial crisis and substantial fiscal imbalances has led to a breakdown in the institutional frameworks that have been previously accepted barriers between monetary and fiscal policies. The pressures have come from both sides. Governments are forcing central banks to exceed their monetary boundaries, and central banks are stepping into areas previously viewed as inappropriate for an independent central bank. So let me offer a couple of examples. First, the well-known benefits of price stability. In spite of those well-known benefits, there are calls in many countries to abandon their commitment to price stability and create higher inflation rates to devalue outstanding nominal government and private debts. That is, some suggest that we should attempt to use inflation to solve the debt overhang problem. Such policies are intended deliberately to redistribute losses on nominal debt from borrowers to lenders. Using inflation as a background for such fiscal redistributions is bad policy from my perspective. It's dangerous, and I'll stop there. I've been known to sort of take my foot and put it places it shouldn't be, but I'll restrain myself. Pressure on central banks is also showing up through other channels. In some circles, it's become fashionable to invoke lender of last resort arguments as a rationale for central banks to lend to insolvent organizations, either failing businesses or, in some cases, failing governments. Such arguments go beyond the well-accepted principles established by Walter Bagehot, who wrote in 1873 in Lombard's treatise classic that central banks should limit systemic risk in a banking crisis by, quote, lending freely at a penalty rate against good collateral. Central bankers have abandoned this principle, this Bagehot principle, in the last few years, but we have not replaced it with a clear alternative. Indeed, actions were often confusing, unpredictable, and lacked a coherent rationale. I believe that central banks need to think hard and long about how and when they exercise this important function as being a lender of last resort. We need to have a well-articulated and systematic approach to such actions. Otherwise, we encourage excessive risk-taking, moral hazard, and risk sowing the seeds of the next crisis. Unfortunately, neither financial reform proposals nor central banks, in my view, have addressed this important dilemma. Breaching the boundaries is not confined to the fiscal authorities asking central banks to do their heavy lifting. The Fed and other central banks have undertaken other actions that have blurred the distinction between monetary policy and fiscal policy, such as adopting credit policies that favor some industries or asset classes relative to others. Such steps were taken with a sincere belief, and perhaps correctly so, that they were absolutely necessary to address the challenges posed by the financial crisis. The clearest examples of these can be seen in the Federal Reserve System, which established credit facilities to support markets for commercial paper and some classes of asset-backed securities. Most notably has been the effort by the Fed to support the housing market through its purchases of mortgage-backed securities. These credit allocations have not only breached the traditional boundaries between monetary and fiscal policy, they at times have generated pointed public criticism. Once a central bank ventures into fiscal policy, it's likely to find itself under increasing pressure from the private sector, the financial markets, or government to use its balance sheet to substitute for other fiscal decisions. Such actions by a central bank can create their own form of moral hazard as markets and governments come to see the central banks as instruments of fiscal policy, thus undermining the incentives for fiscal discipline and undermining the ability of the central bank to achieve price stability. Thus, these pressures, as I said, threaten independence, threaten credibility and legitimacy of central banks, and here calls for how democracy can control the central banks. In my view, this blurring of the boundaries between monetary and fiscal policy is fraught with risks. As I said, these boundaries arose for good reason, and I think we ignore them at our peril. And so I believe that over time we must seek ways to restore the boundaries between monetary and fiscal policy. Another related issue facing central banks arising to the degree to which central banks have expanded their balance sheets, and we all have to a great degree. There are two dimensions to this issue. One is the composition of the balance sheet. In the United States, for example, the balance sheet of the Federal Reserve has changed from one made up of mostly entirely short-term U.S. Treasuries to one that is mostly long-term Treasuries, plus significant quantities of mortgage-backed securities, also long-term. This concentration of housing-related securities is problematic because it's a form of credit allocation, it's a form of fiscal policy, and broaches the boundaries between the two. The second aspect is the overall size of the balance sheet. As I said, many central banks have expanded their balance sheets in an effort to ease monetary policy after their usual instrument, and an interest rate usually, has reached the zero bound. Do central bankers anticipate that their balance sheets will shrink to more normal levels after they move away from the zero bound? Is it desirable to do so? Or should monetary policy now be seen as having another tool at its disposal, its balance sheet, even in normal times? Some have suggested that central banks adopt a regime in which monetary policy rate is the interest rate on reserves rather than a market interest rate, such as the federal funds rate. What that would do would permit the central banks to manage its balance sheet separately from its primary monetary policy instrument, freeing it to respond to liquidity demands in the financial system without altering the stance of monetary policy. Financial markets are particularly enamored with this. In principle, this would take the pressure off central banks to shrink their balance sheets from the currently high levels and simply rely on raising the interest on reserves to tighten monetary policy. The alternative is to return to a more traditional operating regime in which the central bank sets a target for a market interest rate, such as the federal funds rate in the United States, that rise above the interest rate on reserves. Implementing this regime would require in the case of the Fed, require it to shrink its balance sheet to more normal levels. I'm very skeptical of an operating regime that gives central banks a new tool without boundaries and constraints. Without an understanding or even a theory as to how the balance sheet could be used and manipulated, we open the door to giving vast new discretionary powers to our central banks. This violates the principle of drawing clear boundaries between monetary and fiscal policy, in my view. When markets or governments come to believe that a central bank can freely expand its balance sheet without directing or impacting the stance of monetary policy, I believe that various political and private interests will come forward with a long list of good causes or rescues for which the funds of the central bank's balance sheet could be put to good use. Economic theory and practice teach us that monetary policy works best when it's clear about its objectives and systematic in its approach to achieving those objectives. Granting vast amounts of discretion to our central banks in the expectation that they can use it to cure all our economic ills or substitute for our lack of fiscal discipline, I think, is a dangerous road to follow. In June, the Federal Reserve Open Market Committee outlined some principles that would guide its exit from this period of extraordinary monetary accommodation. In my view, those principles represented an important first step in the FOMC's attempt to restore the boundaries between monetary and fiscal policies. In particular, the FOMC clearly stated its desire to return to an operating environment in which the federal funds rate was its primary instrument of monetary policy. As I suggested, to achieve that objective, the Fed will have to shrink its balance sheet back to a more normal level. I interpret this as saying that our balance sheet should not be viewed as a new instrument, an independent instrument for the central banks. The exit principles also indicate that the committee's desire to return the Fed's balance sheet to an all treasuries portfolio. This establishes the idea that the Fed should not use its balance sheet to actively engage in credit allocations. In other speeches, I've outlined a framework that I've termed a new accord between the Federal Reserve and the Treasury. The idea is to enable a central bank to act in emergencies when requested by the U.S. Treasuries or the fiscal authorities more generally, but it would be clear up front that any non-Treasury assets that accrue to the central bank would be swapped for government securities within a specified period of time. This would ensure that fiscal policy decisions remain under the purview of the fiscal authorities, not the central bank. To summarize, it's important for governments to maintain independent central banks so that they're better able to achieve their mandates, the most important of which is being price stability. It's also sound policy to limit discretionary ability of central banks to engage in policies that fundamentally belong to the fiscal authorities or private markets. Establishing and maintaining clear boundaries between monetary and fiscal policy protects the independence of the central bank and its ability to carry out its core mandates. Clear boundaries and resisting the use of the balance sheet as a new policy tool would also improve fiscal discipline by making it more difficult for the fiscal authorities to resort to the printing press as a solution for unsustainable fiscal policies. Thank you.
Thanks very much, Charles. Many interesting ideas there, particularly when we contemplate the exit strategy. Let me now pass over to Axel Weber. Thank you.
Thank you, and I guess I can stay here instead of going to the podium. Well, thanks to GIC and to David in particular for inviting me to join this prestigious central bankers panel. Let me just say up front that I'm not a central banker anymore, so I'll try and bring in somewhat different perspective here. But let me start with the role of central banks and how I view that. And you will not be surprised that a lot of what I'll be saying is very close to what we just heard from Charles Plosser. We're kind of soulmates on this, but let me just reiterate some of the points and then talk a bit more about the European dimension as a sort of passing the baton to Christian, who will talk, I guess, a lot more about that. Now, central banks' core mandate I've always looked at as preserving price stability. It's essentially a public good. It is essential for long-term growth and well-being of nations, and it is also decisive for social stability. So central banks fulfill a very core function of policy making by being focused on price stability. State financing, on the other hand, is not compatible with good monetary policy, and we've seen that in the past. You can start in 200 years ago, when central banks started, the one decisive move we've seen at the end of last century was central banks became independent of the treasuries, and actually in the UK that took until 1990 and afterwards, but independence of central banks is a key achievement today, and central banks should not lightly risk that independence by either deliberately or as a measure of crisis prevention move too close to the realm of fiscal policy, and you've heard that song from Charles before. Now, when it comes to some of the central bank crisis measures, I have the same view. They lie increasingly in a gray area between monetary and fiscal policy. This inevitably leads to more conflicts between monetary and fiscal, and it's not surprising if central banks stretch their mandate into fiscal space that policymakers will want to have a say over how this is conducted and what central banks do. So one corner solution that was just alluded to, and I agree to that with Charles, is it has to be very clear that this is a fiscal agent role and it's not really independently done. Just to give you an example, when the German debt is issued in the market, the Bundesbank, over all the years and still today, has a role in managing those debt issuance. So if there is a less subscription than is needed in order to preserve pricing, the Bundesbank takes these onto their portfolio and then sells them in a more opportunistic way later on. It's a pure fiscal agent role. It has nothing to do with monetary policy. It is basically related to market making in the German debt market. And somebody needs to do that. It doesn't have to be the central bank, but if it's the central bank, it has to be clear. It's a fiscal agent role under the auspices of fiscal policy. Now, crisis measures have very often, in my view, stretched that limit of responsibilities, and many talk about crossing a red line or a line in the sand. I would just portray it as it's a gray area. There is no black and white, but as with every gray area, if you have a difference of views on whether that is fiscal or monetary policy, you shouldn't be surprised that Congress, Senate, parliaments, and policymakers will want to say over that policy, because by and large, central banks have only been freed of political influence for a very narrow, focused mandate, and that is price stability. To stretch it beyond that, you will get policymakers re-emerge in the debate and want to have an influence on that. So you have to be very aware of that. Well, let me focus a bit more general on inflation. Inflation usually comes at severe macroeconomic cost. And let me say up front that this is true for inflation and deflation. They both entail serious misallocation of labor and capital. And for those misallocation reasons, it is key that central banks, somewhat outside the day-to-day politics, are entrusted with securing price stability. Now, if monetary policy stretches into the area of being used or misused as a means of achieving broader political goals, you do have immediately a repercussion from that. Because if it comes at the price of not maintaining price stability, if you waver or put in the back seat the mandate of price stability, you will actually find that the socially weakest part of society, which have limited opinions and options to protect against the consequences of inflation, are the ones that are hardest hit. And I find this debate is now a debate you see in every constituency over monetary policy. Just coming back from Asia, you do actually see that Asia is a prime example of a region that has most of the multi-billionaires of this world by now, but it also has the largest parts of poor members of society. Differences, and this was briefly talked about this morning in the debate, differences between those that are economically well off and those where price increases for food and energy basically impact on a large part of their income and how it is used, lead to some divisions in the desirability of inflation in these areas. And the socially weakest have to be protected. And that's why in many of these areas, core concepts of inflation targeting are really quite unpopular now, because headline inflation still eats away most of the income earned by the emerging middle classes, and it's become a big issue. So central banks have to be very cautious if they modify the focus away from inflation onto other concepts that allow for some more leverage. Now, the key issue that I find is central banks have worked hard over decades to win credibility in their fight for inflation. My plea would be, don't risk that, because once that credibility is gone, you will find it very hard for central banks to anchor inflation expectations. It's a very nonlinear dynamic. It just needs a few slips, and then I think the public will become very skeptical, and establishing credibility again will be a long uphill battle, so it shouldn't easily be dismissed or risked. But let me just focus a bit more closely on sort of some of the monetary policy, and you will find that I didn't comment on monetary policy for almost a year now. I've been in a transition process, and I think it is good that former central bankers give themselves something like almost a year where they don't comment on the area that they worked in. But time is coming where you are entering into the labor market again at some point, and I will be doing that probably in another 4 weeks' time. So let me just give you some views on monetary policy. I think there is a big debate in Europe now about the ECB LTRO operations. And let me just remind people here before Christian speaks, we had embarked on a one-year LTRO as a measure of crisis that at the time was focused on largely banks in the core of European Union, and that is German banks and other banks having problems. And we had longer-term operations in order to help them fund. The decisive intervention by the ECB avoided, in my view, multiple Lehman risks materializing in European banking sphere. This in itself has to be seen as a positive. it has reintroduced liquidity in the funding markets, and it prevented a potential major crisis escalation. So that by itself, as I said, is a positive. At the same time, and due to the very long duration of the two refinancing operations, the ECB has bought time, and the ECB has never communicated anything else, as that operation has to be seen as buying time for policymakers and buying time for banks. They have to increasingly use the degrees of freedom that has been given to them by this operation for a proper policy response, both in the banking world and in the policy world. The window of opportunity has to be used by both policymakers and banks to implement reforms and to basically recapitalize or to de-risk their balance sheet. Only this addresses the root causes of the problem and prevents the crisis from re-emerging again. The LTRO itself should not be seen by anybody in the market as a solution of these problems. It simply gives a window of opportunity to deal with the underlying root causes. And let me focus more on the banking perspective, because the policy perspective has been discussed in and out, and I'm more interested now in the banking perspective. From a banking perspective, it will be dangerous if the time bought is not being used to curtail risks or to reduce exposures in the banking system. Banks that have accessed the LTRO can largely be divided into two categories: the ones that need it due to low asset quality or high exposures, in particular in some Eurozone periphery country, and the rest which is not reliant on ECB funding, but has mainly participated from an opportunistic or strategic perspective. Nonetheless, the more robust funding markets have provided lower quality banks with access to credit investor base. The main question still, however, is on the table. Which banks are really healthy? And the only way banks can answer that is by de-risking their balance sheet and by raising capital, because only a more prudent and solid capital base will answer that question definitely. So banks need to follow up on that action in Europe. There's another question, and it's related to the time window that is available. How temporary is the relief provided by the LTRO? In any case, there needs to be a coordinated strategy to provide funding once the LTRO matures. And I would find it counterproductive and counterintuitive if banks and financial markets were to start working on the assumption that, given the fact that we've seen two of those operations materialize, very bold, very long-term action, that there is more of the same to come. The ECB has clearly signaled that, and I think it is up to markets to really take that serious and now follow up with their own action. Finally, the LTRO also makes the return to normality from monetary policy much more complex, largely because of those divisions between banks that are reliant on it by now and those that aren't. And an exit from the currently very expansionary monetary policy stance will have to be planned very carefully. And since that requires careful planning, I think starting that plan earlier on is very important. You need a good plan on how to unwind this wall of liquidity in 3 years' time. And a staggered process probably is a more reasonable option to pursue. Now, with that staggering, you may have to start at some point. And let me remind you, the ability of banks to return the money to the ECB early was not put there as just part of the language. It was put there because for many of the banks that can do it, it should be a serious option. The best exit from these liquidity measures for banks is to prove in a year's time that they don't need it to the same amount anymore because they regain market access. To regain market access, capital is key. So really what banks need to do is try and front-load that access process in their own sphere in order not to be reliant on the ECB again later on, because the working assumption that the ECB will always be there, I don't think is a good assumption. Thank you for your attention.
Thank you very much, Axel. And finally, Governor Noyer, please. Thank you.
Thank you very much. I'll probably come to the same kind of conclusion as the two previous speakers, but maybe I'll start slightly differently. There is no doubt that unconventional policies implemented during the crisis have transformed the face of central banking, for the time being at least. One question is whether those changes may prove permanent and the unconventional measures become the new normal. There is not yet a definitive answer to that question. We may not, as easily as we would like to, revert exactly to the status quo ante. But I strongly believe that we must make sure that the gains from the pre-crisis periods in terms of monetary and price stability will not be compromised or lost in the process. Now, prior to the crisis, a description of central banks would have centered probably on 4 characteristics. They were focused on price stability as a primary or essential objective, no responsibility sought or given for financial stability. They were limited in size with small balance sheets, and interest rates are their only policy instruments, or almost that. They were clearly independent, condition recognized as necessary to anchor inflation expectations. Axel has just explained that in more details. And that was embodied in very strong institutional frameworks. And I think we can say they were successful. The Great Moderation, a period of exceptional low volatility in output and inflation, was widely seen as at least partly or largely a product of efficient and wise monetary policies. So there was a happy feeling that at last a perennial monetary regime had been found, well tailored to the characteristics of a modern market economy. Financial markets were efficient, and the zero lower bound and liquidity trap appeared as no more than historical curiosities. Well, with hindsight, of course, we can see now that this ideal economy may never have existed. The Great Moderation was as much a product of good luck, brought by disinflationary effects of globalization than good policy. Monetary stability is a necessary but not sufficient condition of financial stability, because capital markets are not always and necessarily efficient, and downward financial spirals may quickly bring our economies to the point where interest rates cannot be used as effective tools anymore. That's the famous liquidity trap that was mentioned or discussed this morning. Therefore, as the crisis unfolded, central banks responded by taking unprecedented measures, and in the process underwent, I think, 3 major changes. One was a diversification of their interventions in order both to unclog financial markets, both private markets and public markets, that involved exceptional liquidity provisions to banks as well as temporary purchases of assets, both private and public. And that was also done to circumvent the zero lower bound and bring down long-term interest rates through purchases of public bonds or in interest rate guidance or long-term refinancing operations. As a consequence, central bank balance sheets expanded, in fact, by a factor of 3 on average, dramatically increasing their role in financial intermediation and raising a number of concerns, at least in some quarters, about the possible inflationary impact. Together, this diversification and that increase in size have created more complex interactions with fiscal policies. Specifically, asset purchases are sometimes seen as quasi-fiscal policies, both on the asset side, due to the risks attached, and on the liability side, when they contribute significantly to meeting the funding needs of the sovereigns. I think that at the time they were decided, those exceptional interventions were absolutely necessary. Although this has been forgotten, central banks have initially been created to protect the economy from excessive financial disturbances. This was historically their raison d'être. As ultimate and unique providers of liquidity, they cannot escape, I believe, this responsibility and let the financial system and the economy collapse. But at the same time, by doing so, central banks have submitted themselves to a number of risks. First, and that's easy to see, but probably not the most important, there are risks linked to the balance sheet expansion. They cannot be ignored, although all central banks have been extremely careful in valuing asset purchased or taken as collateral. Second, and that was discussed at width by Charles Plosser, they run the risk of blurring the lines between fiscal and monetary responsibilities. A dynamic use of the balance sheets by central banks has effects on the allocation and distribution of resources in the economy. They may advantage or penalize some collateral or some borrower. If central banks take additional responsibilities as regards financial stability, they will have to do so in close cooperation with fiscal authorities, and all that may expose them to possible interferences on monetary policy. But perhaps the major risk is the risk of confusion. A multiplicity of interventions can easily be interpreted as a dilution of objectives. There is a tendency by market participants and by some policymakers to consider the central banks as sort of universal problem solvers whose balance sheet can be used without costs and for any kind of purpose. There is also a doubt, at least an ambiguity, in the minds of some analysts about the true purpose of public bond purchases. Central banks' activism may create doubts as to their ability to stick to their core mandate, that is price stability, in front of increasing pressures and increasing constraints. Are we protected somewhat against all those risks by the robustness of our institutional framework? In the case of the euro area, I believe we are to a large extent. First, because price stability is unambiguously the priority objective of our monetary policy. Second, because monetary financing of governments is strictly prohibited. And third, because the euro system, that is the ECB and the national central banks, is extremely well capitalized, and therefore the independence is protected against the ordinary risks stemming from the balance sheet expansion. And this helped the euro system to be able to feel allowed to undertake non-standard measures on a large scale without too many risks and danger for its credibility. Of course, we do not control fiscal policy. We can never accept a situation where fiscal imbalances would constrain monetary policy. It is very important, therefore, that credible fiscal consolidation takes place across the euro area. It will make it easier for the euro system to be active in protecting financial stability. On the contrary, doubts on governments' resolve to ensure sustainability of public finance would make us powerless to fight instability and expose the Eurozone to great dangers. So, if I move now to the more prescriptive part, we may have to live with non-standard measures for some time ahead. Indeed, some central banks have adopted interest rate guidance announcements covering the next 2 years, for instance. Monetary policy will likely for some time rest on the diversity of instruments. Macroprudential measures will interact with monetary policies in a complex way. In that context, I believe it is all the more important to keep clarity of purpose and stick to the two crucial features inherited from the pre-crisis consensus that Axel Weber described in detail. One is the focus on price stability, and the second is corollary central bank independence. There should be no ambiguity about what central banks are trying to achieve. And I think the more non-conventional the actions, the less obscurity there should be as to their ultimate purpose. Non-conventional measures, like any others, can only achieve their objectives if inflation expectations are solidly and clearly anchored. And from that point of view, the calls by some economists and market participants for a temporary relaxation of price stability objectives are, in my view, totally misguided. And I find it significant, on the contrary, that two major central banks have recently decided to quantify the price stability objectives and enhance their communication accordingly, and I think that was for the best. I will stop at that to let the discussion with some time. Thanks.
Thank you very much. Well, those are three fascinating presentations, and many common themes clearly among them. I guess to start with, I'd be interested to know how our panelists view the interaction of asset prices and collateral with the exit strategy of central banks. I can appreciate that the time is now approaching where central banks need to at least start to set out the potential framework under the conditions that they might exit. But at the same time, we were hearing, in fact, from the presentation by Bill Miller just before lunch of the importance of maintaining high values of asset prices, particularly because of the potential negative consequences of a loss of collateral in a very leveraged financial system. So I'd like to ask the three panelists for their reflections on this point. Is it really just a question at the moment of establishing the framework and the theory, but really, as I think Governor Noyer mentioned, it is certainly perhaps some time before this can be put into practice. Here, maybe I start with Charles or Axel.
All right. Well, let me make two predictions. Whenever the central banks will start debating the exit, the market and policymakers will view it as premature, irrespective of when it occurs. Second, the whole debate about there is a system that's leveraged, so the central banks simply have to act to keep that leverage, and the financial system doesn't have to act with its own levers, is the wrong way. Central banks shouldn't view leverage and excessive risk-taking as a state of nature that they need to accommodate. They should send a clear message to financial markets: you are over-leveraged and you have too many risks. Get rid of it. And that's the clear message that markets need to get from central banks. To work in a world where the central banks are always the caretaker of any problem that materializes somewhere else, be it in fiscal space, be it in financial markets, be it in leverage, wherever, is the wrong way to look at things. And I think there is a big risk that central banks become the ultimate sort of caretaker of stability, long-term orientation, and at the same time fix all the short-term problems. At least that's the expectation that some have. I think central banks need to, along the lines that both of the other speakers alluded to, make very clear we have a set of rules and procedures, we have an overriding objective, and that is price stability, and we have a clear strategy. We need to get from point A, where we are now, to point B, where we'd like to be. And that will be a strategy we'll implement over time. I think there is too much expectation in the market about the almightiness of central banks. And having worked in a central banks only have a few instruments at their disposal. None of these instruments are totally independent on one another, and many of the instruments have long-term side effects that are very hard to see early up front. So, like Charles and like Christian was saying, I don't think we need to reinvent central banking. It took us 100 years to get to the point of getting the priorities right. I don't think we're in a new world. We're just very far from steady state in the old world, and we need to get back to that old steady state. I don't think you can reinvent central banking and financial markets. I think we should go back to a reasonable division of labor. Central banks takes care of price stability. Financial markets take care of financial stability themselves, rather than being bailed out all the time by the central banks. And actually, policymakers take care of prudent fiscal policy. That's a first best solution that hasn't changed over the last 100 years. It's just we're very far off that bliss point.
So I won't do much but echo what Axel just said. I do think it's a very, I've said for many years, I've worried that, and this is reinforcing what Axel just said, that the world and the markets have come to believe that central banks are the solution to all our problems. if we could just tweak this or buy that or sell this or do something else, that somehow all our fundamental economic problems will be solved. And that has a particularly strong view among financial markets, maybe less strong in other parts of the economy, but certainly true in financial markets. And I would just suggest that thinking about central banks as somehow targeting asset prices is a very dangerous road to go down. And I think that we don't really want the housing market in the United States to look like it did in 2007. That's the wrong place for us to go back to. That point was unsustainable. It was a bad place to be. We were over-leveraged, oversupplied in housing. That shouldn't be our goal for going back, and it certainly shouldn't be monetary policy's objectives. Asset prices, for the most part, are relative prices of various kinds, and I think we have to be very careful not to indicate or somehow project the notion that monetary policies are about targeting asset prices of any kind. I think that's as I said, a very dangerous road to go down. These are unusual times. I've never made any hesitation about that. We have done things that are highly unusual. In many cases were perhaps called for and justified, but but policies are never free. There's always payback somewhere. And when we undertake policies, we have to think not just about their consequences for today and tomorrow. We have to understand what their consequences are going to be next year and the year after. Whether it be blowing up our balance sheets, we have to think about what are the costs of unwinding from that? What are the risks of unwinding from that? As Axel said, it doesn't matter when monetary policy decides to tighten. It's going to be too early for most people. As my old mentor used to say, it was always, markets always love interest rate cuts, and they always hate interest rate increases, and that's just the way it is. So I think it's very dangerous for us, for central banks, to engage in this view that somehow we're responsible for setting asset prices, either in absolute sense or in a relative sense. So I'll stop.
Christian?
Well, thank you. I probably have not much to add. That's for sure. One day we'll have to again check back the punch bowl, and we'll meet with the same arguments from those who would like to continue to dance. But I think technically the exit strategy is not a big issue. If I take the example of the euro system, let's take all the refinancing operations we've done. It's as easy to withdraw liquidity technically as it is to provide liquidity. When you're a central bank, you can borrow. If you want to do that, you can really take the liquidity out. Now, the reason why I was wondering whether it would be so easy to come back to normal, or so rapid to come back to normal, is simply the result of technical features. For instance, we now have in Europe, and in the Eurozone at least, in Europe more generally, and I fear more generally around the world, an interbank market that does not work as well as it did before. There are many reasons for that. And it's not only that banks don't trust each other. I think it's a too short and too easy explanation. But the fact that the regulators themselves have started a draft liquidity ratio that is totally imbalanced or asymmetric, let's say, between how is counting lending and borrowing in the interbank market, creates a huge, or will create a huge disincentives in banks to interbank operations, and banks are starting to take that into account. So we have to reflect and adapt our tools, especially regulatory tools, to make sure that that we give incentive to the market to come back to normal practice, and avoid that on the one hand we build up reserves from the banks and the central bank system, and on the other hand, we have to provide more liquidity than normal, simply because the markets does not function normally. Last observation. there was a remark made earlier by Axel also. When judging our policies, I think it's too simple to say that we had other objectives than price stability in mind, because price stability is neither inflation nor deflation. So if we felt that we were in a situation where that was what most central banks were thinking, that the not intervening and at a time where we were possibly constrained by the already very low level of interest rates might have driven the economies in a state of very low inflation rate or even deflation rates, at least very low compared with our inflation objective, that could have had very detrimental effects to the economy. So we chose to use unconventional tools in a certain situation and in a certain state. Now, the day that they are not needed anymore, our duty is to remove them.
Okay, thank you. Thank you very much for that. Maybe we can just turn a little bit to focusing on the financial sector and how that's being regulated. Axel spent a few moments there urging the banking sector, as I understood it, to focus on additional capital and to reduce risk. But at the same time, of course, there are macroeconomic consequences coming from that, which links to the previous answers. However, my question is really about the structure of regulation. Are we at a point where you have the single currency here in the euro area, and you really do need a single bank regulator at work for the euro area, possibly a system of deposit insurance, such as you have with the FDIC in the United States, just to ensure that the bank depositors can have more confidence that if there are problems in one particular territory's banking sector, that this can be quite readily addressed in a very coordinated fashion, and more especially to give banks a very clear framework within which to be planning, which is, I think, related to your observations just then, Christian. Can I ask Axel maybe first?
You're going back to the area where basically you have to ask yourself, why in Europe? And whether, if the answer to that is yes, why in Europe did we only move monetary policy to the European level and kept every other policy, except for competition policy, at the national level? Why are European policymakers unwilling to give up national competences towards Europe? You cannot leapfrog that process of moving responsibilities in policy to the European level by simply saying, let's have a single FDIC type of agent, because behind the FDIC, the fiscal authority of the United States government is. So if you decide to have fiscal authority only at the national level, and that's clearly been the decision so far in Europe, you cannot have a single FDIC, because that would just reorganize a distributive process, again in financial markets, that taxpayers are unwilling to see in other areas of competence in fiscal authority. So the big debate is not the details, whether you have a single bank regulator or a single FDIC. The issue is, how do we organize the process of transfer, in particular fiscal responsibility, to the European level, more joint decision making. And it's been clearly stated, starting with Jean-Claude Trichet's speech in Maastricht, Europe is embarking, in my view, on an avenue where we will see more Europe as a result of the current crisis, because it's been pretty clear just moving monetary policy to the European level and keeping independence on fiscal policy is politically, in the long term, not a viable solution. And actually, that was the view in Germany about monetary union from the start, so I'm not saying anything that is new. At some point, if you want to ensure that monetary union is sustainable, you have to take the next step and move policy areas other than monetary policy and competition policy to the European level. And unfortunately, that doesn't happen very proactively, because power in politics is a zero-sum game. If somebody else gains power, you have to give it up to start with at the national level. And that will be a winding and difficult process. In the end, down the road, don't ask me when, I'm pretty confident that Europe will go that direction. But it'll be an uphill battle, it'll be a windy road, and it'll be a bumpy process.
Thanks. Christian?
Well, I agree to a large extent to what Axel just said. Nevertheless, I think that one of the major problems we've been confronted with is really that because of the first episode of the crisis and the fact that after Lehman, all around the world, a number of governments have been obliged to step in and support their banking systems, partly or more largely. What we had achieved to a large extent, that is a banking system which was considered as Eurozone banking system. People had forgotten that behind the banks, eventually the taxpayer could stand. That appeared again as being rather crucial, and I must say not only for the so-called systemic institutions, but more largely for the banking system itself. And of course, that has driven a strong link between the sovereign and the banks in a given country, which makes the Eurozone really not work efficiently at all. So the idea to decouple the banks and the sovereign in a monetary union is of extreme importance. And therefore, the idea of creating a sort of FDIC with competence in the Eurozone is a very attractive concept. But of course, behind the FDIC, European FDIC, might be funded by contributions from banks. But if it has to meet with a very severe crisis, then behind the FDIC, you have the federation, and Axel, I totally agree with Axel that behind the FDIC, you need to have a concept of how to organize the process of transfer, how to jointly decide to capitalize or recapitalize the FDIC. And FDIC means that, of course, bank supervision must be coordinated in an extremely close way. I'm not saying putting all the supervisors in one single place. I think, at least in the US, it's not that way it works. But it must be closely organized with exactly the same practices and the capacity of the center to force a modification of surveillance policies.
Thank you. Just before we hand over to the floor for questions, Charles, be interested in your perspectives here, in your personal views on the issue of bank regulation and what perhaps Europe, if anything, can learn from the US experience there.
Well, the Federal Reserve, of course, is in the process of implementing the Dodd-Frank legislation. It is extensive in its reworking of bank regulation. It is complex. It is difficult to do. Rule writing is now the activity of the supervision part of the Federal Reserve System, and it has been a very difficult process. Having said that, though, I think I've said before that I think one of the issues that we have not addressed as well as we need to, certainly in the United States, is the too big to fail issue. I think that still looms large for how we deal with the financial sector, how regulation works, how policies work via the financial sector, and we still have ample problems with too big to fail, and I think that we've still got a ways to go there. So I think we've made some improvements. I do think that capital is key. I think there are things that we can further do to enhance capital. So I am encouraged that we're moving in the right direction, but I think there's a lot in our regulatory reform in the United States that's really not getting at the problems we need to address. One of them is too big to fail, for example. And so I think we've got a long way to go, but I do think we're on a pretty good trajectory. There's a lot of, I guess I would describe it, excess baggage that's gone along with this. This is a lot of other stuff hanging on to Dodd-Frank that I think has very little to do with the crisis and will not do much to prevent another one. But I also don't fundamentally believe that it's either government's ability or regulatory's ability to say we'll never have another crisis. It's just not, in a capitalistic society and as way markets work, that you can't do that. And even if you thought you could, you probably really wouldn't like the outcomes. So I'll stop there.
Okay, let's have some questions. Hand up over here, please. Thank you. Is there a microphone? Yeah. Thank you.
I'm a veteran of a TBTF institution, Citigroup, that fortunately is able to continue paying my retirement. But I do have the feeling, particularly since I lived through LTCM, that the Federal Reserve in particular, and perhaps the ECB, certainly the Bank of England, failed in its task of supervision repeatedly. I know that there's an argument against fighting asset price bubbles, but the damage that we've seen following LTCM, where we and 14 other banks were required to buy LTCM, plus the fallout from the 2007-2009 crisis, means that we are left with a debate like this. There was no choice for the liquidity trap that Paul talked about so eloquently. Once you, the central bank and supervisors and regulators, let us get into that kind of a situation, there is no choice. You have to save the payment system. And here we are debating about whether or not it was correct. You had no choice because you let it happen.
Let's take a few questions here as well. Another question, just there, please. Yeah, thanks.
My question, I think, is mainly directed at Axel Weber. Mr. Weber, you rightly emphasized the credibility, how important the credibility of central banks is. And one of the foundation stones of the credibility of the European Central Bank was its strict rules on collateral requirements for providing refinancing to banks. And yet, since the beginning of the crisis, the ECB has really had to dilute those standards progressively to the extent now where we have several national central banks, for instance, providing emergency liquidity assistance. Don't you think that it's particularly dangerous for the ECB's credibility? And I suppose what worries me most is that the ECB is effectively locked into these very, very low standards of collateral until at least the three LTROs mature.
Thank you, John. Question at the back there, please.
Hi. Jim Kelly, Kelly Capital. This question is directed specifically at the Treasury side of things, but may apply to the Europeans as well. In this scenario, the U.S. Treasury issues a bond. Investor A buys it, and then along comes the Federal Reserve, who buys that bond back from Investor A. Now the Federal Reserve has the bond on its books. The U.S. Treasury pays the Federal Reserve the interest that Investor A would have otherwise received. The Federal Reserve pays its bills and then remits back to the Treasury Department the excess. I do not understand the financial benefit to the taxpayers, the Federal Reserve, U.S. Treasury. I just do not understand the benefit of not showing the bond to be what I think it is. Hey, it's matured. To me, you guys are two parts of the same federal government. And it's like IBM issued a bond and then another division of IBM bought it back. That bond doesn't exist anymore. So help me understand the financial benefit of the Federal Reserve holding Treasury bonds that aren't in the public market anymore.
Okay, thank you. And then one final question in this first round at the front here.
While we're in here, Chairman Bernanke was giving a speech in which he
So,
highlighted that...
can you guys check? You can hear at the back. Maybe we have the microphone, sorry, yeah.
Thank you. While we were listening to you speak, Chairman Bernanke commented that it's unclear if the pace of job gains can be sustained and that expansion of production demand can be supported by Fed's continued accommodative policy. is it worth asking the question of whether the central bank really should even have a board of governors, since it ultimately feels like, no, I'm being serious, in either administration, it is definitionally part of the body politic that appoints the chairman. And how ultimately do the discrepancies in these views end up being rectified for policy outcomes?
Thank you. Well, many of those questions actually relate to the United States, including that last one. So, Charles, please, would you like to lead off?
I'm not sure I quite understood the question, but I would say clearly the Federal Reserve is we're a creature of Congress at the end of the day. There's no question about that. But there are important reasons why Congress has delegated certain responsibilities to so-called the technocrats in a central bank. And so I really can't comment other than to say we are only who we are through the authority of Congress, and we have I've always viewed we have a responsibility to the body politic, to the public, to be, I think, as transparent as we can be and as accountable as we can be for the things that we can control. I think the danger is that when the body politic in some form or another wants a central bank to do things that it cannot do, and then to hold them accountable for it, it creates all sorts of problems. And so this is about sort of scope and scale of what actually central banks to do. And it goes back to what Axel said earlier about expectations on the responsibilities and the achievements that central banks can in fact make for the real economy. And I think those are limited. I'm going to go back to the question in terms of the treasuries. You described what exactly happens. It does. Treasury will issue U.S. Treasury securities. We buy them in the secondary market. They go on our books. That's called monetization of the public debt. We exchange those debts for new reserves or new currency, and it's called monetization. So you are swapping a piece of government debt for a Federal Reserve note. It's as simple as that. I guess I'll stop there.
Okay, well, we also had some questions, in particular from John, on the collateral issue, which I'm sure Axel and Christian will want to pick up on, in addition to any other remarks they have. Can I just throw in one extra thing there, which I think is of great interest to many people in Europe and beyond, which is the issue of the Target 2 imbalances. And I'd really like to hear for both Christian and then Axel really their thought on how much of a concern really this should be for financial market participants. Thank you. Christian.
Well, first on the issue of the collateral itself, it's true that we have extended the pool of collateral that we are taking for various reasons. One of the reasons being that because the markets, especially the interbank market, was not working properly, then to make it simple, the banks come to us, ask for too much more liquidity than they globally need, and they bring back a lot of this liquidity. That's what is called the reserves, the free reserves. So that we needed more collateral, and we expanded the pool of collateral for that reason. Now, extending, and the other reason was that some countries being downgraded, we had to ask more haircuts for that, or for the collateral of other borrowers in the various countries, and that meant having access to more collateral because we took less value in each collateral. By saying that, I give already the answer. You can very easily take collateral of supposed lower quality, but taking the appropriate risk control measures have the same quality of assets in your books. If you take a big haircut on a lower quality collateral, you normally end with exactly the same value in your balance sheet or the same protection that if you had lower haircuts on a higher higher rated collateral. So that we believe that we, in no way, we have decreased the safety of our collateral, the average quality of the collateral, of the security we have on our balance sheets or on off-balance sheets. Now, it's interesting to look at history and see whether the Eurosystem has lost money in its various operations since the beginning of the crisis. And yes, we've lost some money, or at least we had to pass some provisions because we don't yet have the final end of the story. Where did we lose money? We lost money when a bank called Lehman Brothers collapsed. And where was Lehman Brothers borrowing in the Eurosystem? Actually, it was in Germany. It could have been in France, it could have been in the Netherlands, it could have been in Italy. It was in Germany. So that I happened to make a check to my colleague in Frankfurt, just to bear the cost relating to my share in the Eurosystem for something that had happened and was hurting all of us. So Axel was taking, what, 1/3, I was taking 20%, and our colleague in Italy was taking 15%, and so on, and we all made a check to the Bundesbank. So that's what how it happens. If tomorrow we have, and we had, by the way, another event that took place in Luxembourg, because the Icelandic banks used to borrow their money in Luxembourg. And in that case, of course, it was not the Central Bank of Luxembourg that could write the whole check. We all had to send a check to Luxembourg. Probably we'll get back most of the money in the end, but we will see. But that shows that the money we so far think we might have lost, we didn't lose it in the so-called peripheral countries. It was very much in the center. Lesson, well, we have to make sure that our counterparts are solid. In the case of Lehman Brothers, everybody thought it was solid before it collapsed. And we have to make sure that the collateral we have is sufficiently well protected. And we have reinforced the way we calculate that. We've done a lot of work in the Bundesbank and the Banque de France in particular to make a better valuation of collateral and suggest the appropriate haircuts that are decided by the Governing Council. So I think that's basically that. On target two balances, maybe I let Axel explain what it is.
Well, the episode Christian reminded you of was something we talked over lunch. And basically on target two balances, let me start with my view on how I always view target two balances. If we had decided against the explicit discussion of the Banque de France, the Banca d'Italia, and the Bundesbank, who had major repo departments and markets departments that did all the repo operations with the banks in their constituency, if we decided to start from scratch and have the ECB have a large markets department centralized in Frankfurt at the ECB, something like target two balances would have never occurred, because the ECB would have lent into the market to all the banks in the constituency called the euro area, and we would have seen the bilateral lending and repo operations and collateral pledges to the ECB. In a monetary union, that's the way you need to look at a central bank operation. That is a common monetary policy operation. And the only time we had a counterparty fail in the system was the Lehman incident, where actually they used the Bundesbank. And what happened was everybody shared the risks of this lending operation of the euro system to a banking entity in its constituency along capital keys. So my view on target two balances, Germany's exposure or risk, if you want to call it that, to ECB lending operations is 1/3 of the balance sheet of the ECB. It is 1 trillion. The whole number about how the bilateral operations of the central banks contribute to that, in my view, is an accounting device. Only if you look at the risk of a common currency from a national perspective, it becomes irrelevant, and in my view, it is an irrelevant debate. But I think we really have to understand, we have by construction created a single entity Europe, the Eurozone with a common monetary policy. And we're all in this with the balance sheets of our central banks in capital proportion. So all that is relevant for me for the target debate is we, as German central bank, and I'm not anymore with that institution, but we owned a third of the risks of any operational aspect of the ECB. I had never any other view on that. And what Christian just said, what is very important, yes, you asked about the lending and the collateral rules. It can be a concern if you lend against inappropriate collateral, if you don't do the right haircuts, if you don't do the right valuations, and that is clearly a concern if that were the perception of what the system does. And that's exactly what Bagehot meant. You have to lend freely against collateral that you need to evaluate against its value. And that is an issue I think the central banks need to control. I don't know, because I've been out of this operation almost a year, what the exact quality of collateral is that being pledged and what the haircuts are, but I take it that what the ECB president, what Christian said before, that the institutions are working prudently together to assess these risks and to take appropriate haircuts. Now, there was one issue about the gentleman from Citi who's glad that he gets his pension from Citi. It sounded a bit like the central banks are in charge of a failure. Let me remind you, the first line of defense for prudent bank management is the board of management of the bank and its supervisory bodies within the bank. Both have failed. When both have failed and there is no prudent risk management, you invest in assets that have fallen strongly in value and you're not sufficiently capitalized, the central banks and taxpayers sometimes have to step up to the table. But the first round of problems occurred in the bank. It was imprudent management of risk and imprudent internal supervisory processes to control and manage these risks. And of course, that should always be, if you look at a problem, it has many dimensions, but that should be the first dimension where we need to work at. So financial institutions need to improve their risk management, need to improve their capability to judge the intrinsic value of assets. There's been too much lending going on simply based on external assessments of credit rating agencies and others on the quality of the collateral and too little own prudent risk management as part of how you run banking operations. And that has to change. And I think that's the first set of work that banks need to concentrate on. Improve your risk management, improve your capacity to manage risks, and don't excessively go into risk by being over-leveraged in certain market areas. I think that is just sort of the standard approach that banks should take. Be prudent on managing risks. And then I think if you do that, of course, short of a systemic crisis, in a systemic crisis all market values fall. And clearly this dimension was there, a systemic dimension was there in the last crisis that we've seen in the United States. But the first couple of banks that encountered problems clearly didn't have those problems because of a systemic dimension then. They clearly had it because of excessive leverage, too short-term funding of assets that really didn't hold up in collateral or in their intrinsic values when the funding markets have turned. So there is a mixture of both. And I wouldn't push all the problems onto the central bank saying this is a failure of the supervisors to supervise institutions prudently. There's been clearly a failure of institutions to manage themselves prudently as well.
Ladies and gentlemen, the key goal with the Central Banking Series and the Global Interdependence Center for the last dozen years has been to demystify central banking, to encourage a dialogue. The more we understand and learn about it, the better we will all be. I would say for the last hour and a half, we've had a wonderful lesson from a great panel. Thank you very much.